Hello friends, welcome back to JK Shah classes. Today we will be doing revision of Investment Fund, Chapter 12 FB. Investment Fund is a small chapter again on the same lines just like Business Trust that we discussed in the previous session. Again applicable on the same lines as in pass-through status will be applicable here also, and they work on the same lines as in case of principle of collective investment just like mutual fund and business trust. Investment fund will also be collecting funds or collecting money from small people like you and me. Collected funds, a large amount of collected funds will be invested somewhere. Where do mutual funds invest? Mutual funds invest in stock market. Where do business trust invest? Business trust will invest either in real estate projects or will invest in infra projects. Where do investment funds invest? So investment fund, let me first of all tell you that in SEBI language, they are called as AIF, Alternative Investment Fund. They invest anywhere. There are three categories of AIF. AIF category 1, category 2, category 3. Here taxation we are going to discuss only about category 1 and 2. Category 3 AIFs are not covered by our government in direct tax. For category 3 in real life there is a confusion. In exam they won't ask you about category 3. In fact in exam they will not even clarify which category AIF is it. They will simply tell you it is investment fund. Very simple chapter. Category 1 and 2, they invest in infra projects, they invest in startups. Ideally, they invest in startups. In the name of startup, they can invest in private companies or unlisted companies also. But ideally, they collect funds and invest in startups with the same idea that out of every 100 startups they invest, few of them will flourish, remaining 900 or 90% will go bankrupt. Okay, in this chapter we are going to discuss section 115 UB is the main section that we will be discussing, which will have 7 subsections. Then 2 sections of exemption, 1023 FBA and section 1023 FBB, and TDS provision section 194 LBB. In business trust chapter, main section was 115 UA, here it is 115 UB. There it was 1023 FC subclause A, subclause B, subclause C, and 1023 FD. Here it is 1023 FBA and 1023 FBB. And in business trust chapter, TDS was under 194 LBA. Here TDS is under 194 LBB, which we will be revising briefly in TDS chapter as well. So this ideologically is AIF, Alternative Investment Fund, registered with SEBI and registered under International Financial Securities, International Financial Services Center Act also. Okay, so first of all you need to understand that under pass-through status, whatever income is earned by investment fund, let's say investment fund is earned 1000 crore and you are one of the unit holder. Based on the number of units held by you, out of 1000 crore of income earned by investment fund, they distributed you 20,000. Your share was 20,000 rupees out of total income. Out of total income earned by investment fund, just like business trust, pass-through status, so PGBP income is 70%, that is 700 crore out of 1000 crore. 210 crore is capital gain, which constitutes 21%, and income from other sources is 90 crore, that is 9%. So when they pass on 20,000 rupees to you, in your hand also same percentage and same nature of income will be applied. Same nature and same proportion of income, that is what we mean when we say pass-through status. So in your hand also 20,000 into 70%, 14,000 rupees will be PGBP income. 21% of 20,000, 4,200 will be capital gain income, and 9% of 20,000 rupees, that is 1,800 rupees, will be income from other sources. Out of these incomes, which all incomes are taxable for investment fund and which all incomes are exempt for investment fund, that is what we need to discuss. Remember one fundamental thing, 2/2 table, certain incomes which are taxable for investment fund will be exempt for unit holder. Investment fund, unit holder. And whatever is exempt for investment fund, that much will be taxable for unit holder. Simply, certain incomes will be taxable for investment fund and certain incomes will be taxable for unit holder. That is what is the concept of pass-through status. If taxable in the hands of unit holder, for unit holder it will always be taxable as per normal regular rate of tax applicable to unit holder. So let's try to understand that out of total incomes, only PGBP income, business income will be taxable for investment fund. You just need to remember this much, rest all is opposite of what we discussed. So whatever is taxable for investment fund will be exempt for unit holder under 1023 FBB. During the lecture I used to call it as 1023 Facebook B and Facebook A. So barring PGBP income, all other income in the hands of investment fund will be exempt under 1023 FBA. So the table which I drew up here, that table will be applicable here also. TEET, TEET. So PGBP income TE and any other income ET. And whatever is exempt for investment fund will be taxable for unit holder. The question is, whatever is taxable, that is PGBP income is taxable for investment fund, in the hands of investment fund, at what rate will it be taxable? Answer, that tax rate depends upon whether investment fund is a company or a partnership firm or others. If it is a company, then the tax rate is 30%, but 2 years back, if the turnover was up to 400 crore, then a tax rate in the current year will be 25%. And in case if it is opted for section 115 BAA, if it is company and has opted for 115 BAA, then the tax rate will be 22%. Now 15% tax rate could not have been opted by investment fund as a company. 15% tax rate is only for manufacturing company. So if it is company, then 30, 25 or 22. If it is partnership firm, which includes LLP also, then tax rate will be 30%. If the investment fund is anybody other than firm, company and LLP, like if it is an AOP, trust, BOI, etc., cooperative society, then tax rate will be MMR. What is MMR? Maximum marginal rate of tax. MMR, that rate will be applicable. So if it is company or partnership firm or LLP, then 30, 25 or 22% will be applicable. Other than company or firm, then MMR, which is 42.744%. And when certain incomes are taxable for unit holder will be taxable as per normal rates as are applicable to unit holder. Right? Technically, chapter is over. This is what is there in this chapter. If you remember this table or this chart, your work is done. Now remember TDS provision, which will be repeated in TDS chapter also. Now whatever is exempt for investment fund, when they pass it on to unit holder, for unit holder it is taxable. Since taxable, therefore investment fund will be required to deduct TDS. TDS will be under section 194 LBB. And that TDS will be at what rate? That depends upon residential status of unit holder. Unit holder is resident, then TDS will be at a flat rate of 10%. And if unit holder is non-resident or a foreign company, TDS will be at the rate in force. And rate in force means rate given in Finance Act. How much will be that rate? Rate in force will be depending on whether it is foreign company or other than foreign company. Foreign company, then tax rate was 40%, now 35%. Of course, plus surcharge plus health and education says, that is needless to say, but TDS rate will be 35%. If it is other than foreign company, other non-resident, then 30%. Plus surcharge plus health and education says. Okay. Now 1023 FBA, investment fund will be exempted for any income other than PGBP income. Other than PGBP will be exempt, PGBP will be taxable. And for unit holder, what will happen? This is for unit holder. In the hands of unit holder, whatever is the PGBP income, that will be exempt in the hands of unit holder. Whatever is the PGBP income of investment fund in the hands of investment fund received by unit holder under pass-through status, it will continue to be called as PGBP income proportionately. Okay. Now main section is 115 UB. 115 UB has 7 subsections. One by one we'll be discussing. Out of these 7 subsections, you just need to do some of them. TDS section, 1023 FBA, FBB and 115 UB. These are the 3 key ingredients of this chapter. 115 UB subsection 1 and subsection 3, both of them talk about pass-through status. This talks about pass-through status with regards to investment made. Whatever investment fund makes, you making investment in investment fund and investment fund making investment in target investment, it will be deemed that You only have made that investment directly. And same pass-through status with regards to income. Whatever income is earned by investment fund and passed on to you, it will be presumed that investment fund does not exist, that income is received directly by you. Both of them are unimportant, simply remember pass-through status. Subsection 2 is important, loss. Now, same concept, whatever we applied for positive income will be applied for negative income. Positive income, what did we discuss? PGBP income taxable for investment fund. Then PGBP loss will be allowed to be carried forward by investment fund, allowed to investment fund. And other than PGBP loss, other loss will be allowed to be carried forward for the normal period, 8 years then 8 years, 4 years then 4 years, unlimited period then unlimited period. Other than PGBP loss like capital loss, long term, short term, other source loss will be allowed to unit holder. But will be allowed to unit holder subject to condition that only if units are held by unit holder for more than 12 months. More than 12 months. If the units are held for less than 12 months, then this loss other than PGBP loss will lapse. PGBP loss will be allowed to investment fund, therefore not allowed to unit holder, and other loss other than PGBP which is allowed to unit holder will not be allowed to investment fund. Whatever is the status of income, wherever income is taxable in whosoever's hand, negative income will also be handed over to that person. PGBP income is taxable for investment fund, therefore PGBP loss will also be handed over to investment fund. Other than PGBP income is taxable for unit holder, then other than PGBP loss will be handed over to unit holder. But while handing it over to unit holder, there is one condition: unit holder should have held the units for minimum 12 months or more than 12 months. If units are held for less than 12 months, then what will happen to other than PGBP loss? Then that much loss proportionately cannot be carried forward and set off by anybody. For unit holder, no, because units are held for less than 12 months. For investment fund also no. Clear about the loss? Okay, then subsection 2 is done. Subsection 4. Subsection 2 is important, keep it in your mind. PGBP loss, investment fund will take away. Other than PGBP loss will be handed over to unit holder, provided unit holder held the units for minimum 12 months. Subsection 4 talks about a tax rate applicable to investment fund, that we are already done with. Whatever is taxable for investment fund, that will be taxed as per rate applicable depending upon whether it is company, firm, LLP. Company, firm, LLP, then will be taxed at 30% rate, 25% rate or 22% rate. And if it is other than company, firm, LLP, then MMR, maximum marginal rate of tax, which is 42.7744%. Subsection 5 is totally unimportant. I had made you cancel it out during concurrency of the regular lectures also. It says applicability of chapter 12D and chapter 12E to investment fund. Chapter 12D is DDT, dividend distribution tax. This chapter is also deleted. And chapter 12E, income distribution tax, which was applicable to mutual fund, this is also deleted. Therefore, this entire subsection is unimportant. Subsection 6, deemed credit. This is something important you need to remember. Deemed credit, it says if income is not distributed by investment fund to the unit holder till 31st March, year ending, then on 31st March, it will be deemed to have been distributed in the same proportion in which they would have been entitled to, unit holders would have been entitled to, had there been actual distribution of income. Deemed credit on 31st March of the given financial year. However, then after that, right now it is deemed to be credited to the account of unit holder. Unit holder will be taxed right now, and investment fund will be required to deduct TDS, because tax is deducted either at the time of actual payment or at the time of crediting payee, whichever is earlier. Though there is no actual payment and though there is no actual credit, but because of this subsection 6, there is deemed to be credited in the account of unit holder on the last day of the financial year. Therefore, TDS liability will arise. Unit holder will be taxed or not? That depends upon what method of accounting unit holder is following. The explanation 2 later on states that no double taxation. No double taxation means what? Means when this income is actually distributed, which is already taxed on credit basis, deemed credit basis, as per 115 UB subsection 6, should not be taxed once again when it is actually distributed by investment fund later on. Subsection 7, unimportant from exam perspective, you are unit holder. I am investment fund, I distributed you 20,000 rupees. Out of 20,000 rupees, how much is PGBP, how much is capital gain, how much is other source, how will you come to know? So answer, investment fund will have to furnish one statement, investment fund, this is IF means investment fund, one copy of statement to unit holder and one copy of statement to income tax department, that is to CIT, CCIT. For unit holder, it will be in form number 64C, which you need not remember. For income tax department, it will be in form number 64D. Just like business trust, it was 64A and 64B. Here it is 64C and 64D. By 30th June of the next financial year, that is after March ending April, May, June. But it is unimportant, neither the form number nor the date, nothing to be remembered. It is just for your knowledge that by issuing statement, unit holder will come to know after receiving this statement that how much is his income. 139(4)(f) IT return is filing is mandatory for investment fund. This we will discuss in assessment procedure chapter also. And now the last is TDS. So for TDS, one thing for sure that for TDS, tax will be deductible by investment fund while making payment to unit holder of such an income which is taxable for unit holder. Which income is taxable? So answer, other than PGBP. So TDS will be deductible only when this income is passed on proportionately to unit holder. TDS will be under 194 LBB. If the unit holder is non-resident or foreign company, then TDS will be at the rate in force. And in case if unit holder is resident, then TDS will be at 10% rate. And what do you mean by rate in force? Rate in force is nothing but rate given in Finance Act or the rate given in Income Tax Act, whichever rate is applicable. So in Income Tax Act, there is no rate given for this kind of income. Therefore, rate of tax given in Finance Act will be applicable. Remember one thing, the rate of TDS may be different than the rate at which income is actually taxable in the hands of unit holder. Unit holder may be taxed at slab rate, but TDS will be at flat rate, that is possible. Rate in force will be if it is non-resident or foreign company then 35% plus surcharge plus health and education cess, and in case if it is other non-resident then the 30% plus surcharge plus health and education cess. At what rate will the person be taxed? So unit holder will be taxed. If he is non-resident, he will be taxed as per slab rate under old tax regime, new tax regime versus DTAA rate, whatever is beneficial to him. But TDS will always be at standard rate 30%. Questions are separately asked also in the form of MCQ only on TDS part also. So you need to remember the section number also and the rate of TDS. Rate of TDS for foreign company till last year was 40%, now brought down to 30%. Which income? So answer, income other than PGBP, nature of income. That's it. With that, this revision of this chapter comes to an end. See you in the next video with the next chapter.